We do hear quite a lot about private credit in the news cycle. There's some sensational headlines, but right now I think we see the economy, the real economy is very healthy.
It makes for a better story when it's the end of the world.
There is a view amongst some parts of the retail channel and certainly amongst larger managers that bigger is better.
I would have intuitively thought bigger was safer. And what you're telling me is not necessarily, because when you have a problem, it's harder to sell those businesses because it's so widely known.
What's your take on all the headlines about the bankruptcies and the risk to private credit?
Good afternoon, Patrick Dwyer and Greg Pool here at NewEdge Wealth. And we have a special guest today, our friend Tim Lauer from New York City. Tim is the founder and CEO of Willow Tree, a $6 billion private credit shop. And today we're going to talk to Tim about private credit and how it's not all the same. Right?
Tim, can you maybe just give us a little overview of Willow Tree?
Sure, Greg and Pat, great to see you guys. We are as Pat said, approaching $6 billion asset manager, primarily focused on middle market direct lending. So we invest in senior secured loans to middle market borrowers, generally in sizes ranging from 5 million of EBITDA all the way to 75 to 100 million of EBITDA.
Fantastic. Everyone, including our clients, are reading a lot about private credit in the news and the headlines. I'm not sure everybody understands what private credit is. Maybe explain what's going on at Willow Tree and in the private market these days.
Well, we do hear quite a lot about private credit in the news cycle, and I think there's some sensational headlines that we can get through later. In day-to-day operations here at Willow Tree, we are seeing the results of that action start to drive M&A activity. And when M&A activity ramps up, loan issuance app ramps up, that becomes a very active time for us. We have large portfolios of borrowers. We monitor those. So we get a good snapshot of what's happening in the real economy and what's happening with earnings in our industries. We are not a snapshot of GDP. So there are a lot of industries that we don't have exposure to. But right now, I think we see the economy, the real economy is very healthy. And we're excited to continue to deploy in our core strategies of lending to the middle market. Here at Willow Tree, it's been an active year. We have signed a new partner in 100 Point Capital. We've recapped our business. They are a phenomenal GP stakes firm and have already added quite a lot of value to our global distribution efforts. So lots of activity in the broader markets and lots of growth ahead here at Willow Tree.
So when people talk about private credit, Tim, most clients are in, some large private credit fund from Blackstone or Ares or whatever. And then there's a lot of overlap between those funds. They own a lot of the same types of loans. Would you describe, your firm, your approach, and how you're different from those kind of large retail funds that everybody has?
Yeah, I think that there is a view amongst some parts of the retail channel and certainly amongst larger managers that bigger is better. And I would say scale is important to a certain extent. You want to have scale to drive origination, to drive good outcomes in IRRs in terms of expense ratios. But I think there are certain upper-ended reaches of scale where scale becomes somewhat of a diminishing return profile. So what has happened in the largest markets is many of these firms have raised $10 billion, $20 billion, $50 billion funds. And they tend to all fish in the same pond of what we call mega tranche loans. So these loans are to companies with 500 million, $1 billion of cash flow sized at 3 billion and 4 billion. So much larger transactions than we target, or the core middle market targets in general, or has in the past. And as a result, a lot of overlap, as you mentioned, occurs in these portfolios because there's 40 or 50 of these a year that get done that are held by 9 or 10 firms. So when investors are looking to diversify, they do find it challenging to only look towards these large firms. which is where a firm like Willow Tree, I think, can play an important role. We have portfolios that are distinct from what you might find in the larger managers. Again, we're focused on a $5 million to $75 million borrower. That's really where the asset class has deployed over decades and shown really good performance. In this new upper middle market asset class, I worry that the performance of old may not show up for a number of reasons. One, these are much larger businesses that have more leverage on lower quality of earnings, and importantly, documents that are not quite as stringent as what you'd expect in a senior secured loan document. They look more like a high yield loan indenture. And so in a default, you've seen this happen very publicly where collateral can leave these borrowers and damage recoveries. I think another consideration where bigger may not necessarily be better is when you think about working out a very large business. So if you have a $500 million company in terms of EBITDA that goes to $250 million of EBITDA, it's really challenging to find a buyer for that business in that workout scenario because there's only a handful of private equity firms that are large enough to take a business like that out of a bankruptcy. There may or may not be corporate bids for those businesses. If there are corporate bids, you have to go through a regulatory process, which means a very long and expensive bankruptcy. In our part of the market, if we have a $50 million borrower that goes to 25, there's a very tried and true cost-cutting exercise where cash flow break even or stability can be achieved. And there are hundreds of firms that will buy that business. And so driving towards a par outcome in the rare circumstances where we have or can experience a default is something that we've done over and over again, and the core middle market has done over and over again. You haven't really seen that much data come out on these large borrowers to predict what those outcomes could be. So again, bigger is not necessarily better when you factor in leverage in the form of that leverage in that market.
That's interesting. So let me summarize what I think I just heard you say. If you're in the larger funds, which we have lots of clients in those, they tend to all be doing the same 50 deals every year. These are very large deals. When they go poorly, there's not a lot of buyers for these deals when they fall apart. In the higher mid market, lower mid market, when the deals fall apart, you can cut costs pretty fast and get to a place where you can actually exit that business. It's easier to sell in a difficult market. That's actually the opposite of what I would have thought. To be honest with you, Tim, I would have intuitively thought bigger was safer. And what you're telling me is not necessarily, because when you have a problem, it's harder to sell those businesses because it's so widely known.
I think there's really a difference between upper middle market, core middle market, and lower middle market. And I think certain people say bigger is better. And, knowing nothing else, I would probably agree with that. But when you look at the kinds of leverage that attach themselves to these scenarios, I think the outcomes can be maybe counterintuitive, where a bigger business might not achieve the same sort of recovery on its loans that a middle market business would. When you think about cost cutting, you have a very big business. These businesses that have thousands of employees, they need all the functional groups. You need an IT department. You need an HR department. You need really big parts of your finance and administrative functions, or the business can't run. When we have a middle market business, a lot of those functions can be replaced by third-party service providers, FAs. And so you're thinking about a $25 million business and an ability to cut $5 million of expenses out of it. You've just lifted earnings 20% by going through that exercise. Even if you're able to do that in a $250 million EBITDA company, you're talking about lifting earnings 1 or 2% to remove all of that cost. It just doesn't move the needle in terms of where leverage can go and really where cash flow neutrality can go, which is what you need in a workout. You need to get to a place where you're not putting capital into the company, stabilize it, find a buyer, and exit. All of those things are just a lot more difficult when you're dealing with a $300 or a $400 million borrower.
So when you're thinking about investing in private credit today, kind of walk me through, what do you think is a realistic return for a fund like yours, where you're generating, for a fund like yours, kind of the next kind of 3 to 5 years, kind of what's the range of, obviously you can't know where rates are going to be, right?
Sure.
Like ballpark, give me a range of what you think a reasonable expectation would be for an individual.
I would say private credit across 20 years is for good managers delivered a double-digit return. I would say that's really across rate cycles. That's what the asset class is supposed to do. It's supposed to generate consistent cash income for investors without volatility at a premium to traditional fixed income. And it adds the benefit of also being interest rate protected. And I would say the next 3 to 5 years is really not expected to be any different. Of course, we're seeing the Fed cut and we're seeing floating rate strategies, all in absolute returns, come down. That's just math, right? If base rates decline a bit, you may see, overall absolute yields come down a little bit. That being said, I'm personally a fan of easing in what's happening at the Fed because it's going to stimulate more activity. I think the asset class has suffered somewhat the last 3 or 4 years because M&A volumes have been so depressed because people are looking at a 21 vintage multiple, going through, earnings that have not been gangbuster and trying to find an exit. And I think this valuation problem that people have had somewhat gets solved when the economy does get a lift. And so as you see that happen, you may see spreads, which have also compressed, start to normalize as supply and demand rebalances as a result of some of this action at the Fed.
What do you think? I mean, what's your take on all the headlines about the bankruptcies and the risk to private credit? There's a lot of consternation. Certainly the press likes to talk about it, but even among our clients.
It's odd to me. I mean, I don't know where it's coming from. It's really hitting a lot of the news cycle. When you think about the SEC conducting a systemic review or review as to whether or not there's systemic risk, including there was none, I think that answered the question. The government did a long-dated study. And, I think what people don't appreciate necessarily is that this collateral is now all held in either unlevered or one-to-one levered or modestly levered funds. And the GFC was held at banks, with leverage at these banks as high as 25, 30 to 1. And so as a result, you saw this cascading of loan prices for 18 months. Even for performing credit, you saw things trading below par. So that was something that really didn't work and has been regulated and I think more or less fixed. You then saw a test in COVID and, loan market went to 80, came back to par in 30 days. And I think investors saw stimulus coming and knew the outcome of what stimulus can drive in terms of earnings and asset prices. But the fact that we're hearing so much about one or two deals and, that are held by maybe, 0.5% of the overall $1.5 trillion or whatever you're calling it, private credit market, and it's coming from JP Morgan, who is launching their own private credit business. It just doesn't make a lot of sense to me. I don't think any of these headlines portend systemic or broad-based risk. I think they're not changing institutional appetite towards investing in an asset class that's proven to produce great returns, both risk-adjusted and absolute, for decades. We've gone through multiple periods of stress and I think have answered the tests quite well as an industry. And I think we're well positioned within it to continue to outperform.
It kind of reminds me a little bit of what happened with Blackstone BREIT after rates went up. The press just started attacking it. They started getting everyone panicked about it, like these apartments were just going to be worthless or something. And I would talk to the Financial Times all the time about it and say, look, I don't think this is a panic situation. I think it's going to have a, mediocre year as cap rates get adjusted, but I think it's going to be fine. And they were like, no, it's the end of the world. And it wasn't. None of those things happened. I'm like, this is the apartments, and they're not over levered. And it was very interesting. It was the same sort of thing. And I didn't see it was just sort of I think it's people hate the competition.
It makes for a better story when it's the end of the world.
I think so. And I think you had a number of things that were hitting, the public BDCs. And so you had this confluence of headlines, a couple of high, profile defaults, and the sector trading off. And the sector traded off because the Fed cut rates, and there was, I think a pump up in the stocks in terms of being held by hedge funds over the last 3 or 4 years. I mean, I think people understood that rates going up were going to be great for dividend coverage, and a movement away from that, I think, caused the market to overreact. And so I think there was a lot for the press to point to, but we're very patient long-term investors. We are not spread timers. We're not looking for excess spread on every deal. I'd say most of my peers are similarly disciplined. Our job is to invest in credit, focus on fundamentals, earning stability, loan to value, coverage, and manage defaults. If those companies get through all the risk filters that we build as firms to conduct long and thorough due diligence. So, again, I don't pay a lot of attention to headlines. I've had to answer a lot of questions around First Brands and Tricolor, even though we're pretty disclosive as to what our assets are, and they're not on there. I mean, these are companies that, are so far away from the mandate of Willow Tree in terms of whether or not we would invest in these kinds of situations. So we're, again, just executing on what we do and what we know best, focusing on those sectors that we like, that we're overweight, that we think operate very well in expansionary and potentially recessionary times, and whether rates are high or low. That's really our job: consistency and discipline.
If you were to sort of pick out the best people, and you've been doing this a long time, you had a great career. I think you were at Ares. I mean, you've been in this space your entire life. What are like the 2 or 3 things that you think really make Willow Tree better than a lot of the other shops?
So we think we do a number of things well that differentiate our firm. I think number one, we built the firm where senior management would be focused on investing. That's why people come into our funds. They're excited that, yes, I'm the owner, I'm the CEO, I've had a long career, I'm still doing deals, I'm still doing due diligence with the team, meeting 3 times a week at the investment committee. We think that shows up in our numbers. My partners, Jim and Alex, are the same. I think 2, we have a flexible solution that many of our peers can't wrap their mind around or won't bother to bring to market. This really centers around a lower middle market strategy where we can help a business that starts at 7 or 8 million of cash flow grow all the way to 50 million with a very flexible solution. Finally, we have operating advisors that create bespoke origination opportunities that have sourced some of our most compelling, risk-adjusted, downside protected, but also highest IRR opportunities. So those 3 things come together. We hope to build differentiated performance, but also very distinct portfolios. I mean, part of our job as a manager is to show the market, yes, there's a lot of options in private credit, and all of them do a pretty good job. They'll do 6, 7, 8%, even in times where, there's some stress that hits the market. We need to show the world that we're a diversifying choice and that we're not going to be more of the same that you might get from the larger managers, and that we have strategies that we think can continue to outperform.
In summary, Willow Tree is a really high quality shop, focused on a little different part of the market than most of the products that are available to ultra high net worth clients from the big banks. And you have a pretty strong belief that the space is going to continue to deliver pretty reasonably good returns, kind of in the 10 to 12% range, is what I'm hearing.
I do. I think, it may be harder for the indexed, and I'll call the larger managers more indexed funds. So we're not a snapshot of GDP. We don't own a lot of things that are in private credit portfolios. We don't own technology lending, for example. We don't own oil and gas. We don't own consumer, restaurants, retail, industrials. That's a big chunk of GDP that we don't think we can make a good credit case for. And so if we do see rates continue to decline, you may have more of a 9 to 10% net return targeted by folks.
And if you were talking to investors and you would say, what would you avoid? What would you stay away from in today's private credit market? Like, where is the places you would not go?
Well, the highest parts of the market in terms of defaults so far, I think, have continued to be industrials and consumer. So these are parts of the economy that fall first and fall hardest when capital spend and discretionary spend fall off. I would be careful around tech and recurring revenue lending. That never made any sense to us. And I think you're seeing not a lot of impairment necessarily in the loan collateral, but a lot of the loan collateral going PIK, going non-cash pay. And you can't service lenders if you're a levered portfolio, nor can you pay dividends with non-cash pay instruments as your investments. So those are places that, we tend to avoid, that we think, don't offer the most compelling downside protected returns versus other things that we do see in the market.
When you say tech, you mean software companies?
So what's happened in technology lending, and I wouldn't say that anyone at Willow Tree is not long software. Automation will continue to drive software. Obviously, people worry about AI threats to all things related to software automation. In credit, what happened, I would say 5 or 6 years ago, is there was a lot of lending done to negative free cash flow businesses with the thesis that if growth slows, and I've got this company I paid 30 times for, if it stops growing, we can cut the sales force, harvest cash, and service debt. Well, if I paid a high growth multiple for a company, the last thing I would do if growth slowed was to cut my sales force. I would invest more money in it to keep it growing. And I would call my lender and say, your next interest payment is a default or you're going non-cash pay. And so we kind of saw that coming in that market, and it's why we avoided it. And, here we are 2 and 3 years later with some implementation, certain software sectors aren't growing the way they used to. All the debt that's underpinning that is PIK. And, that is something that, we never thought made sense. And I think our investors, consultants, et cetera, give us a lot of credit for avoiding.
Now, there's going to be a lot of change in that space going forward as well. So it's getting harder to underwrite. So I think you've done a great job talking about the landscape as well as Willow Tree and why it's different. And I'm also happy to have you on, and thanks for making this happen.
Thank you, guys. Appreciate it.